Good morning. My name is Kim Anderson, and I am a CPA with Rooted Planning Group. If you are looking for fee-only financial planners and investment advisors, Rooted Planning Group is the group for you. Over the next 30 minutes or so, we are going to take an inside look at qualifying for financial aid. So stick with us, and I think that you will learn a lot through this process. I'd like to start my presentation by finding out where you are on the college timeline. Are there any parents of high school seniors here? How about junior parents? Sophomore moms and dads? How about freshman moms and dads? Anyone have younger children? I'm glad you're here because getting into college can be complicated and paying for it can definitely be scary as college prices continue to rise far beyond the rate of inflation. Educating yourself, as you are today, is the best way to boost your odds of finding good schools at affordable prices. What a lot of families do in this process is simply rely on luck. Parents let their children apply to any schools they would like, and then they keep their fingers crossed that their children get accepted and receive large awards to make college affordable. Sometimes it works out, but often it doesn't. Unfortunately, poor college decisions can ruin a family financially. Let me state the obvious here. Luck is not a plan. It's far better to understand how to research the generosity of schools well in advance of applying, and a critical first step in that process is to understand if you will qualify for financial aid. Like I just said, a critical step when seeking to make college more affordable is to answer this question: will I qualify for financial aid? You may assume that you know the answer to this question, but often parents don't. The more expensive the schools that your child is aiming for, the more likely you will qualify for need-based aid. If money is an issue, you need to answer this important financial aid question because it will help direct you to the types of schools that your family should be exploring. Parents often assume that there must be some kind of income cutoff figure that will disqualify them from financial aid. Could it be $100,000 or $150,000 or $80,000 or something else? The process would be simpler if there was a specific number, but there is no income or asset cutoff that disqualifies a family for financial aid. The financial aid formulas are too complex to generate a yes or no answer on this question based on an income figure. To answer the financial aid question, you need to determine what your expected family contribution is. An expected family contribution is a dollar figure that represents what a financial aid formula believes a household should be able to pay for 1 year of a child's college education. The EFC is based on many factors, including the number of children in college, adjusted gross income of parents, adjusted gross income of student, and assets of parents and the student. There are two EFC formulas. The federal formula is tied to the free application for federal student aid called the FAFSA. This is the federal aid application that students must complete to qualify for federal and state aid, as well as institutional aid at the vast majority of colleges. The institutional formula is tied to the CSS profile. This formula is used by nearly 200 mostly private schools to determine who will get their in-house money. Many brand name schools use this formula. Sometimes the formulas generate similar expected family contributions, but other times they can be significantly different because of what the formulas focus on. To give you an example of what kind of expected family contributions are possible, I'm taking a look at the kind of EFC that a middle-class family with modest assets can generate. The EFC for this family using both methodologies is around $2,500. With this modest EFC, the family would ideally be looking for schools that provide very good need-based aid because their ability to pay for college is limited. After obtaining your EFC, you'll need to subtract that from the cost of the school to see if the family has a chance for need-based aid. In this example, a middle-class student would ideally receive $57,500 in need-based financial aid. In this example, I'm using an affluent family with considerable home equity and taxable assets. You need to keep in mind that retirement assets don't hurt aid chances for financial aid, which is why this example does not include any. The calculator determined that the federal EFC was $31,072 and $35,185 for the institutional EFC. At some expensive schools, this student would be eligible for need-based financial aid. At less expensive schools, such as in-state public universities, the student would be looking for merit scholarships that aren't connected to need. The EFC for families will drop significantly when there are 2 children in college at one time. The EFC drops by roughly 50% for the federal methodology, the FAFSA, and about 40% for the institutional methodology, the CSS profile. Because of the strong tie between the EFC and the number of students who are in college simultaneously, parents who space their children closer together can really benefit. As you can see in this slide, the more children in college, the lower your EFC will be. With 3 children in school with the federal methodology, for example, the EFC will drop 66% for each child. A low or modest EFC indicates you have less financial resources to pay for college. Families in this situation should be looking for schools that provide excellent need-based aid. They should also make sure to apply to their own state schools. Be aware that state universities outside your borders are highly unlikely to provide need-based to outsiders. State schools typically only provide merit aid to non-residents. If you discover that your EFC is high and money is an issue, you'll want to look for private and state colleges in and out of your state that provide merit scholarships to affluent students. Most schools fall into that category except for the most elite institutions, which don't provide scholarships to high-income students because they can attract many wealthy students without this carrot. It's important to obtain your EFC as soon as possible for 2 important reasons. Number 1, obtaining your EFC will give you an idea of what kind of money schools will expect your family to pay, at a minimum, for 1 year of college. And number 2, it will provide you direction on whether you should aim for schools that provide excellent financial aid or aim for schools that provide merit aid that is given regardless of financial need. The best resources to obtain your EFC is on the College Board's website. To generate the most accurate results, you'll need your income tax return and your non-retirement investment account statements to generate your EFC. If you want to do the calculations yourself, head to the College Board's website where you can find an EFC calculator. It can be tricky completing this calculator correctly. If you'd like assistance in generating your EFC, I can help you in a one-on-one complimentary session. I'll share more about this opportunity toward the end of this presentation. Here's one more reason why the EFC is valuable. Your EFC can also be incredibly handy at the tail end of the admission process when you've received your financial aid awards. You won't know if a financial aid package is stingy or awesome or somewhere in between if you do not know what your EFC is. Financial aid letters often don't include your EFC. If you don't have that number, and your EFC can vary by school, you can't evaluate if an award is generous or not. In this example from Pace University, the student's EFC is 0, which means that the family's AGI is $25,000 or below. The EFC is at the very bottom of this award letter. The student received grants totaling $33,075, which might seem generous, but it looks stingy when you consider that the student's EFC was 0. The letter states that the student's cost for 1 year would be $28,900, and that exceeds the family's income. If the EFC isn't on your award letter, contact the school to find out what it is. If the award letter is inadequate based on your EFC, you can appeal that award. Lots of parents are naturally worried that the investments will hurt their chances for financial aid. This won't be a concern for many parents because the aid formulas ignore some assets. I'm going to take a look at what the FAFSA ignores first. Neither the federal formula, the FAFSA, nor the institutional formula, the CSS profile, penalize families for their qualified retirement accounts, such as IRAs, SEP IRAs, 401ks, 403bs, KEOs, and pension plans. You could theoretically have millions in retirement accounts and it wouldn't hurt your aid chances. The FAFSA also ignores annuities, the cash value in life insurance, and assets of family-owned businesses with 100 or less employees. The FAFSA also doesn't ask families if they own a primary home. You should not include your home equity when asked about your assets on the FAFSA. The FAFSA, however, will treat the equity in vacation homes and rental properties as assets. If you are divorced or separated, the FAFSA has special rules regarding financial aid that in some cases can boost the chances for financial aid. Here's a big advantage. Only the custodial parent will fill out the FAFSA, so only the custodial parent's assets and income will be counted for financial aid purposes. The higher ed world relies on an unusual definition of custodial parent. Let's say the FAFSA will be submitted February 1st on 2020. The parent who completed the FAFSA would have been the one who took care of the child for more than 6 months going back to February 1st, 2019. Let's use an example to see how this custodial role can play out. The mom is a physician who makes a hefty salary and the ex-husband is a high school teacher. If the family wants to reduce their college costs, it would make sense for the teen to live with the dad, the lower wage earner, long enough for him to be considered the custodial parent. That would mean staying with the dad at least 6 months and a day. If the dad was a custodial parent in this case, the mother's higher income, as well as her assets, would not be divulged. With only the lower income parent filing the FAFSA, the student would be more likely to qualify for more financial aid. It's important to understand that who claims a child on tax return or pays child support is irrelevant when determining who is a custodial parent. If the custodial parent remarries, however, the new spouse's income and assets must also be shared on the FAFSA. And that's true even if the couple had a prenuptial agreement that specified that the new spouse would not be responsible for college costs. Household size does impact financial aid. You should count stepchildren in a family, even if they live elsewhere, if the custodial parent provides more than half of their support. The CSS profile, which I mentioned earlier, is an additional application that mostly selective private schools use. The CSS profile does consider more assets than the FAFSA. The CSS profile does ask about home equity and the adjusted net worth of a business or farm. And some CSS profile schools will consider the cash value of life insurance and non-qualified annuities. Let's take a closer look at how the CSS profile treats home equity. Many schools that assess home equity for financial aid purposes do so by linking it to the family's income. For instance, a family might assess home equity at no more than 2 times the family's income. This way, the formula is less likely to hurt families that are house rich and cash poor. Let's look at an example of how this would work. Let's say the family's income is $60,000 and the home equity is $200,000. Schools that use the CSS profile formula assess home equity as well as other parental assets at 5% for financial aid purposes. So the home equity at $200,000 times 5% is $10,000. In this example, the home equity value would have boosted the expected family contribution by $10,000. This would be a huge financial hit. But now let's look at what happens if the school tied the home equity assessment to no more than 2 times the family's income of $60,000. So $60,000 times 2 is $120,000. In this example, the school would only use $120,000 of home equity in this family's aid calculation. So $120,000 times 5% would be $6,000. In this example, the parent's EFC would increase $6,000 rather than by $10,000. It's important to ask schools what their policies are regarding home equity. If your child applies to schools that also require filing the CSS profile, the rules on divorce will vary by school. Some CSS profile schools will treat divorce just like the FAFSA does. Many CSS profile schools, however, will want the non-custodial parent to share financial information by completing what's called the non-custodial CSS profile. You can find the schools that require this non-custodial aid application by checking out the list of CSS Profile schools on the CSS Profile website. CSS Profile schools will typically consider the income and assets of the two biological parents. Some, however, might consider the financial wherewithal of new spouses as well. How a CSS Profile school handles the divorce issue can depend upon how much a school likes an applicant. You'll need to ask schools how they treat divorce in financial aid cases. The FAFSA and CSS Profile both agree that some assets need to be considered in aid formulas. These are the child's assets, taxable assets, trusts, and college accounts. So let's take a look at these. I cannot emphasize enough that for most families, parents' non-retirement assets will not hurt their chances for financial aid, and that includes 529 college savings plans. Saving for college will provide you with more college options and will make it less likely that you will have to borrow to pay for a bachelor's degree. It's a myth that the people who decide not to save for college will be in a better position to win greater financial aid packages. Saving for college is a very smart move because families will have more choices. For every $10,000 you save, need-based aid would only be reduced by $500 to maybe $564. And in reality, the amount will even be smaller. And just because a student's eligibility for aid is reduced doesn't mean he or she would get more grants, which is free money. A college could simply include more loans in the aid package. There's another factor at play here. The FAFSA formula shields some parental non-retirement assets from being considered at all. How much parents can protect will depend on the age of the oldest parent on December 31st of the year the FAFSA is filed. So in this situation where the oldest parent of a married couple is 50, the parents could shield $12,500. For aid purposes, the parents' assets that aren't protected are assessed at 5.64%. In this example, you can see that even a large amount of money saved up can have a rather modest impact on a student's eligibility for financial aid. In the second example, the parent's assets have zero impact on the student's chances for need-based financial aid. That's because what the parents have saved up is less than their federal asset allowance. The CSS Profile methodology also shelters some parents' assets automatically, but just how much isn't known. The CSS Profile is a proprietary formula, and some of it is kept secret. The CSS Profile assesses unprotected parent assets at 5%. It's best not to have money in a child's name because this money is treated more harshly. The aid application will be interested in the value of a child's assets that are supposed to be based on the day the applications are filed. The student's money is assessed at a stiffer rate than the parent's assets. The CSS Profile assesses students' assets at 25%, and the FAFSA assesses them at 20%. Unlike their parents, students do not have an asset protection allowance. So here's an example. If a student has $5,000 in his checking account, schools would consider $1,250 for the CSS Profile school and $1,000 for the FAFSA schools, and that account would be available to pay for college. The family's EFC would increase by that amount. Just like parents, a student's retirement assets are not counted in aid calculations. The FAFSA formula allows students to shield all or a portion of their income. For the 2018-2019 school year, a student can earn $6,570 for the year and not jeopardize aid. The CSS Profile does not provide an income allowance for students, but rather it assumes that all students will contribute something to their college education. Many CSS Profile colleges require that students contribute in the $1,800 to $2,300 range. The EFC is hiked by that much for their education, regardless of whether they have a job or a savings account. Money that students earn in a campus work-study job or co-op job will not count in their eligibility for financial aid. While financial aid formulas penalize money held in a child's name more harshly than parents' assets, most students don't have enough assets for this to make much of a difference. A major exception can be money tucked away in a custodial account, the UGMA or the ETMA. Custodial accounts are assessed for financial aid purposes as children's assets. As I just mentioned, the FAFSA assesses child assets at 20%, and the CSS profile assesses these at 25%. One way to limit the damage if a child has considerable money in a custodial account is to close down an UGMA or UTMA and pay an applicable tax and then move the cash into a custodial 529 college account for the child. The FAFSA will assess money in a custodial 529 plan, just like regular 529 plans, as a parent asset for financial aid purposes. Not all CSS profile schools will assess custodial 529 money as if it was the parent's assets. If this is a concern for you, contact the school to ask how they assess custodial 529 accounts. Be careful about the timing of shifting money from a custodial account to a custodial 529 account though. Liquidating the account can generate capital gains, and that is reportable on the FAFSA and CSS profile for the student. Grandparent assets will rarely impact financial aid as long as the assets aren't withdrawn for college. It gets tricky, however, when grandparents begin to help with college costs. The money that grandparents use to cover college costs is considered the child's untaxed income, and this income is assessed up to 50%. That's a stiff penalty. To avoid jeopardizing a children's or a grandchild's chances for financial aid, grandparents should ideally wait until the second to last application has been filed and then help pay for college. If financial aid is at stake, grandparents should be strategic about when they help. The use of 2-year-old tax returns will make it easier for grandparents to help earlier and not jeopardize a grandchild's chances for financial aid, which is great news for families. Here's why timing is important. The FAFSA asks if anyone beyond the parents has contributed to a child's college costs in the base year. Traditionally, the base year has been the calendar year before the child starts the new school year. For a student who was enrolled in college in the fall of 2016, for example, the base year was 2015. Consequently, if a grandparent helped with college costs in 2015, that would have been reported on the FAFSA for the 2016-2017 school year. And this money, as you've already learned, would have been treated as the child's income. Because of this rule, grandparents have traditionally been told to ideally hold off on helping until the last financial aid form has been filed. This has typically been in the late winter or spring of a child's junior year in college. After that form is completed for the child's senior year aid package, a college would no longer ask about a family's finances. The base year rule, however, has now changed, and that allows grandparents to help out earlier than in the past. Beginning in the 2017-2018 school year, parents began using their prior IRS returns when applying for financial aid. This means that the base year is not the most recent calendar year completed prior to the start of the school year, but 2 calendar years prior. Because the parents are using 2-year-old tax returns, grandparents can safely start helping with college costs after the family has filed for financial aid for the upcoming junior year. Parents would routinely file for aid for the 3rd year of college in the fall or winter of the child's sophomore year. There are some other grandparent options of waiting to help until the second half of a child's sophomore year in college is not practical. Grandparents can simply contribute to a 529 account that parents have already established. This way, all the assets will be assessed at the lower parent rate. A grandparent with a 529 plan could also transfer the ownership of the account to a 529 account controlled by one of the parents of the child. Once the transfer is made, the money is treated as a parent asset, which is assessed at not more than 5.64%. If your family is too affluent to be eligible for need-based financial aid, and it doesn't matter how grandparents save for college or how they help pay the tab, grandparent contributions only jeopardize need-based aid and not merit scholarships. So here are the biggest influencers of financial aid. The income from your the income from your tax return, parental non-retirement assets, including 529 accounts, the number of children in college, and the children's assets and income. Parents are often curious about ways to boost their chances for financial aid. Maximizing eligibility for financial aid can often only be tweaked at the margins. I'm going to share a few of those possibilities. You need to know when the financial aid clock starts ticking. The base year, for instance, for students in college for the 2021 and 2022 school year will be 2019. So it's your income in 2019 that will matter. That's because the financial aid system now requires parents to use their 2-year-old tax returns, referred to as the prior taxes, instead of the most recent tax return. The federal government made the significant change so financial aid process wouldn't be so rushed. Since your financial aid situation can change, particularly since financial aid will be dependent on an old tax return, you can ask for a professional judgment from a school if your financial situation has changed. Whatever your base year will be, try to avoid extra increases in income starting in the first base year. These include retirement plan distributions, employment bonuses, exercising stock options, and converting UGMA and UTMA accounts to custodial 529 plans. If you are hoping to qualify for financial aid, it is best not to sell investments in a base year that would generate capital gains in taxable accounts. These profits, if they aren't offset by investment losses, will be treated as the investor's income. When a family needs to sell investments to cover college costs, they should try to balance the assets they tap from investments that have generated gains with those that haven't. Losses can offset capital gains up to $3,000 in income, and any excess capital losses can be carried over to future years. You are expected to report the value of your assets on the day you file the FAFSA, so it's better to submit the application on a day when the stock market has performed poorly or you have paid your bills. For financial aid purposes, the lower the account balances, the better. The same goes for any money in your child's accounts. And by the way, if the financial markets crash after you have filed the FAFSA, you cannot go back and update the aid application with your assets' lower value. Because children's assets are treated more harshly for financial aid purposes, it's typically best to spend the child's money first on college costs. Remember that child assets are assessed at 20% for the FAFSA and 25% for the CSS profile. You can also draw down money in a child's account for such expenses as a car, test prep, camps, tutoring, and a computer. Don't give a school an excuse not to award your child financial aid. Always meet aid deadlines, and it's best to apply for aid as soon as possible. The first day you can complete the FAFSA and the CSS profile is October 1st of a child's senior year in high school. It's possible to file that early because you are using 2-year-old tax returns. Some parents hope their teenagers can be declared independent students so they can qualify for need-based financial aid, but earning that designation will be impossible for most teenagers. On the slide, you can see the types of requirements necessary to become an independent student. Children will not be considered independent just because they are living in their own apartment and paying their own bills. One other way to reduce your college costs is to claim a higher ed tax credit. For most parents who qualify, the best tax benefit will be the American Opportunity Tax Credit. Qualified parents can claim a maximum $2,500 tax credit for each child in college. Tax credits are more valuable than tax deductions. Taxpayers can claim 100% of the first $2,000 they spend on qualified college expenses for a student and 25% on the next $2,000 spent. Tuition and fees and course materials such as textbooks, supplies, and equipment are eligible expenses. Room and board do not count. Parents can use this credit for no more than 4 years of college. To qualify, a family's modified adjusted gross income must be under $80,000 for a parent filing as a single taxpayer or under $160,000 for married parents filing jointly. There is a phase-out period to this. What's tricky about using the American Opportunity Tax Credit, as well as other tax credits and deductions, is that there is no double dipping. Parents can't use the same educational expenses to qualify for more than one education tax benefit, and that includes tax-free withdrawals from a 529 college savings account. Those tax-free withdrawals are considered an educational benefit. So for instance, if you withdraw $4,000 from a 529 plan to help pay for college tuition, you could not use that same expenditure to qualify for the American Opportunity Tax Credit. Finally, I want to give everyone an opportunity to have a one-on-one session to generate your EFC. Please go to our website, www.rootedpg.com, and to the Take Control Contact Us tab at the top. You can choose which financial planner you'd like to be contacted by. Using the calculator can be tricky, and some parents just guess at filling out some of the questions. This can result in faulty figures. We can help boost your chances of obtaining accurate EFC verdicts. Here's a snapshot of what your EFC estimate using both methodologies will look like when we help you obtain those critical figures. So if you have any questions about this process, have any questions about student loans, financial aid, the EFC, please do contact one of us at Rooted Planning Group. Again, we are a fee-only financial planning firm, and we are more than happy to help you obtain accurate figures so that you can send your child to college for a fair fee, for a fair price, and so they can leave college without being drowning in financial loan debt. So please do contact us. Thank you and have a great day.